Hi, all. Welcome to the Riot Lunch and Learn series, the place where we spotlight Riot's sponsors and partners. My name is Natalie Ballard. I'm the Events and Operations Manager for Riot. Just a quick couple reminders before we get started. This event is being recorded and will be posted to Riot's YouTube channel and uploaded to the meetup page where you registered for this event. If you have any questions throughout the presentation, please place them in the chat. We'll be monitoring the chat and we'll read the questions aloud throughout the presentation. Questions are read aloud for those watching the presentation at a later date. Finally, please keep yourself muted throughout the event to help mitigate background noise. Today, we have Sean from Fourscore Business Law to discuss the legal lowdown on startup financing. Sean, I'll turn it over to you.
Thanks, Natalie. Hey, everybody. My name is Sean Valley, and like Natalie said, I work at a law firm called Fourscore Business Law, based in Raleigh, North Carolina. Working from home today, so you might see my cat in the background here. He's one of our strategic advisors. So apologize if he's jumping around in the background. But like Natalie said, I'm going to be discussing today some basics of startup financing. So as you're growing your company and potentially positioning to bring in some external funding, particularly from large-scale investors, this presentation will help you position your company for that kind of large transaction. Feel free to ask questions as we go through this. I've got the chat pulled up, so I'll be able to see if you've got questions. I'll address them as we go through. And I'll also leave some time at the end for us to chat about any questions you have. And if you have any kind of specific questions about your company or things you just don't want to chat about on the recording or in front of a full group, please feel free to reach out to me afterwards. Riot will share my contact information. I also have my contact information in the slides at the end. Happy to chat about any sort of questions or concerns you might have, and potentially establish a relationship from there. So I'm going to share my screen here and we'll get going with this. All right, I'm going to talk a little bit about just Fourscore to help you understand a little bit about what we do, as well as what any kind of law firm that you might work with as a high growth company would offer and how they would be structured. So at Fourscore, we have this model that ideas deserve opportunity. And what that means for us is that we are actively engaging in different ways to help transform ideas into real world opportunities. We are a team of lawyers and legal support staff, but we do so much more than that. We, in addition to providing general legal work, which I'll describe a little bit more later, we also help clients with things like establishing board meeting practices, advising you as you are preparing for a financing round, or helping you position for some kind of successful exit, such as a merger or acquisition. So you can always reach out to me or anyone on our team to have conversations like that. And I also provide some very in-depth kind of risk and strategy consulting type work to help you position your company for successful exits. So it's more than just the traditional like document drafting or things like that. We're really trying to help take your idea and create that into a real world opportunity, however that looks. So some of our internal mottos are to simplify the complex. Obviously, legal documents can be very complicated, and we, as much as possible, try to simplify that and help make it understandable for everyone. We try to have clear expectations with you on pricing. And to that end, we have a bunch of different ways that we structure our billing models. It's not just the archaic hourly billing model. And you should talk to any early stage company lawyers about billing structures like that. A lot of early stage or lawyers who are working with early stage companies are going to have some flexible billing models, different types of billing models to help with companies at your stage. We do superior quality work, and we do a best to respond swiftly and set expectations on timelines for projects accordingly. We break our practice area up into 3 areas, and I think this is helpful to talk about because it gives you a sense of, again, for any kind of lawyer that you might be working with for your company, where you would be engaging with them. So the main area that I work in particular at our firm is around venture and angel financing. But really this financing or fundraising practice encompasses things all the way from like applying for grants or other non-dilutive funding where you're not giving out equity or other ownership, to doing a friends and family round, to actually raising from large scale venture financing groups. And so a lot of our clients are on the company side, so we're helping the company raise money, but we also do work with the investor side as well. And what that means is that I have a very strong understanding of all the different pieces that are that investors are looking for when they're investing in high growth companies, and can really help you understand what you need to do in order to raise money from those folks. Our second major area is around mergers and acquisitions. And this is when you're going to do some kind of exit. A lot of times this looks like either an asset sale. So you're selling all the stuff like the IP, the website, actual physical products or inventory that your company might have off to a new third party that would come in. Or it could look like an actual stock or other type of equity sale, meaning that the person is coming in and buying the stock from you as a stockholder, and they will then take over the company as the new stockholders. Of course, you can have combinations of financings as well, where someone is coming in to take over a majority or slightly less than the majority of the company. So there's lots of nuance to these different areas. And finally, we lump into our third category of practice, this general counsel services. And what this really looks like is all the other corporate stuff that you might need to get your company from just getting off the ground up through that point of an exit. So we help clients with new business formation. If you haven't set up the company yet, if you have set the company up yet, making sure that you're properly set up in order to position for high stage growth. We help clients develop template contracts for customers, vendors, suppliers. We help you negotiate contracts with specific people and train your internal team to understand what types of provisions and agreements you can negotiate or the implications of that. We help with employment issues, particularly around equity compensation when you are going to give some kind of equity like stock options to your employees. We also help clients review leases for different types of agreements. We help you review licenses for intellectual property, and we help clients with actual contract dispute and resolution. All right, now getting into a little bit of the actual details of the startup financing process. The first piece you always want to think about when you're approaching fundraising is to have a strategy. The two big questions I always suggest for clients when you're starting to think about a fundraising round is first, what's your end game? This is not so much the end game in terms of just the financing, but your end game in terms of the company. So where do you actually want this company to go? Do you want to do an exit in 5 years, in 3 years, in 10 years? Is this the type of company that you just really enjoy developing and working for, and you want to expand and run this as a career? Because the answer to that question will really dictate what you're willing to do in terms of financing and what types of ownership and ownership rights you're willing to give up. So it's very common if you're going to try to do an exit in 3 to 5 years or even 10 years that you're going to need a lot of money to get there, and therefore you might be giving up a lot of ownership in exchange for that money. Similarly, if someone's going to be bringing in a lot of money into your company, they're probably going to expect something like a board seat or other significant types of control. And so if you know that you're going to go down that path, you can start to adjust your expectations to what you're going to need to give up in order to get there. But if you think you might keep your company as a career and just continue to run it, and this is what you want to do, maybe you will position your company a little bit more for sustainable growth and try to achieve a revenue positive company and a profitable company more than you would just try to raise a bunch of money quickly. And then similarly, if you are going to try to do that more like long-term slow growth, you might not even need outside capital to get there. You might be able to fund it yourself or take on a little bit of a loan or something like that, not have to give up equity in your company, but get to a point where you're revenue positive and can fund your company with the actual profits that you develop. So we always want to start with why. Why are you raising money? Like I said, if you want to exit quickly, speed is an important factor there. If you're going to try to grow very quickly, you're going to need to have the capital to do that. So a lot of times we see clients that are doing very well before the financing round, and they just have an opportunity come up to expand their product offering very quickly. And in order to get there, they have to be able to develop infrastructure. They have to be able to market or advertise, and they need funding to do that. Similarly, they might also need to just hire more people, employers or contractors, which is a huge expense. And so they need money to be able to do that. Similarly, you might also just want to be able to validate the product in the investment space. So, so thinking about the types of financing that you might want to get, the types of investors you get in front of can be really important in order to just validate the product and be able to help take you to the next level. And third, sometimes you just need that money to survive. So particularly right now with the way that the investment ecosystem is, we have a lot of clients going through what are called down rounds. And what that means is that you might have already raised money, but now because your company is struggling to survive, you're struggling to satisfy different expectations you set before the market turned down a little bit, they just need money to survive. So unfortunately, sometimes in order to just continue the company the way you need to do it, you've got to bring in that external capital, and you've got to bring in external stockholders, directors, other stakeholders. Obviously, ideally, you would try to raise money or position your company before you get to that point, because unfortunately, if you are raising money in order to survive, you're not in a great leverage. You don't have a lot of leverage. You're not in a great negotiating standpoint, and you might have to accept unfavorable terms or terms you just otherwise wouldn't need to accept if you were in a better cash position. All right, so we'll talk about a bunch of different financing sources and think a little bit about how they have different motivations, right? So it's very common for people that first do what's called a friends and family round. This can take a whole lot of different forms. We'll talk a little bit about the kind of complexities of that. But really, what this is looking like most of the time is if you have people who are a little bit more wealthy, have money available to put into a high-risk startup that you know, or your other co-founders know, they might just want to help you get this company off the ground. They might really believe in the idea. They might believe in you, and they might see a positive return on this investment. So oftentimes when you're thinking about approaching these people, you want to think about it in terms of what you're trying to do, and bringing them in as part of that is a way for them to get in early, to be part of something exciting that you're doing. You're probably familiar with the idea of crowdfunding, so you can always raise from the crowd. Crowdfunding is a way to try to raise from all kinds of different people, so people who aren't just necessarily wealthy. And of course, you have to go through different platforms to be able to do that. And it's a much more nuanced process to actually just raise from the crowd, the public generally, through these crowdfunding platforms. But a lot of times people on these platforms are looking for some kind of actual economic return and an opportunity to be part of something exciting. So again, a lot of times when you're turning to crowdfunding, you want to think about, what is my company have a mass appeal that people are going to want to be part of and get in early with. Just like Riot, there are plenty of accelerator programs out there, and many of them will put in capital in exchange for equity as part of your participation in that program. Those accelerator programs are often looking to develop a portfolio so that they can build out this network of companies that they have equity in and help make all those different companies successful by having that broad portfolio network. And similarly, they're going to be looking for a financial return as well. Angel investors are people who often are very, high net worth, who are willing to write big checks early on. They might be investing individually. They might be coming in through an investor network. For example, here in Raleigh, North Carolina, the NC State alumni have what's called the Wolfpack Investor Network, which is basically just a network of angel investors who are affiliated with the NC State ecosystem, and they utilize that network as a way to find good investment opportunities together. There are also other networks of angel investors that will invest together in that are set up in different just cities as part of different organizations or other universities. Again, a lot of times they're going to be looking for some actual financial economic return. Some of them oftentimes will be wanting to have a targeted social impact. So they might be focused on a specific social issues that the companies will be influencing. And a lot of times angel investors just seem to be motivated by bragging rights, right? And particularly if you're affiliated with the university, being able to help invest in other university startups and creating a name for a startup that came out of your university, your alma mater. Venture capital groups are going to be these larger investment groups, right? And so a lot of times with these, it's not individual investors, it's an actual entity that is investing. A lot of times these are structured as LPs, like limited partnership structures of some sort. And so all the individuals will come in and they will be part of this fund, and the fund and its employees will be making investment decisions on behalf of that fund. They're going to be primarily motivated by return. So and a lot of times they're going to be writing checks at a little bit later stage in the company. And once you've generated positive revenue, can demonstrate that this will have an economic return for them. And they're going to expect that the deal structure will give them a positive return in the future. You can always turn to banks too. Banks are a good source, oftentimes, of non-dilutive funding. If you got a loan of some sort, they are going to primarily be looking for a return, right? So they are looking to write a check in exchange for getting interest or some sort of other return. Sometimes banks will also take certain types of equity as part of their arrangement, and that just looks different with each bank structure. Part of the challenge as well with banks is that you oftentimes, especially if you're early stage in the company, have to personally guarantee the loan that you take out. And what that means is that you as a founder, or you as, whatever role you are in as the startup owner of your company, will need to personally guarantee the repayment of that loan. So if the company, for whatever reason, collapses, can't meet its repayment obligations, you're on the hook, and they could come after everything that you own individually in order to get that payment. So it's a little bit more risky for you as an individual. The government offers a lot of different grants as well. If you need suggestions or ideas for people to help you identify, manage, apply for, and report around grants consulting, we have some great contacts for that. It's a great way to try to apply for non-dilutive funding, but it is a complex process, right? If people are going to just be giving you money in exchange without receiving anything in return, they're going to want to make sure that you're using that money in the way that you say you are. So there's oftentimes complex reporting obligations. The applications can be complex. And so again, if you need support with that, I have great contacts for that, people who can help you with that type of work. The benefit, of course, there is that all they're really looking for is to have an economic impact. Again, a lot of these grants will be targeted towards different types of founders, companies, industries, and the goal there is just to help promote those spaces or those individuals. So they're not looking so much for any kind of specific give back in return. And finally, if you can, try to save as much as possible and fund things yourself. Obviously, that totally depends on your situation, whether you're doing this on the side and having a steady income stream from elsewhere. But if you can really prioritize saving as much as possible and allocating some of your own funding into your company, that allows you to maintain as much of your equity and your ownership in the company as possible, and can prevent you from really getting into situations where you have to take what you've developed and turn it over to other people who are now in control, or at least have a say in what you've created. Sometimes too, you're just going to be in situations where this is what you have to do in order to get where you need to go. All right, I hit on some of these already, but there's really kind of 4 types of financings that we get to. These grants, which, as I mentioned, are non-dilutive. What that means is they're not getting ownership interest in your company, so you get to keep all of it. You might do what's called a convertible security or convertible equity. And what that means is that you're not giving actual stock or other ownership up in your company right when you get the money, but the money is considered either a loan or some kind of analogous structure that will convert into equity down the road when you do a bigger fundraise and sell actual stock. So the 2 most common types of convertibles are notes and safes. The SAFE stands for the Simple Agreement for Future Equity. The difference between these is that notes are really just debt. So they are a debt that your company is taking on, and you'll still have to repay that at some point. But if you were to do some form of qualifying stock financing down the road, where you sold certain types of stock to other investors, instead of having to repay those notes, they might just convert into that stock on certain preferential terms. So the benefit of that is that for the investors, they know they're going to get their money back, because it's just like a debt, so you'd have to repay it at some point, or they could get equity in the company. And so similarly for you, the upside is that if you do a financing down the road, you just took on debt, but you don't have to repay that debt anymore because you're giving it back in stock. A SAFE is somewhat similar to that in that it can convert when you do a future financing, but SAFEs aren't straight debt like a note is, meaning that you don't have an obligation to repay the SAFE. So there's a whole lot more risk for the investors, but it's much better for the company, because if for whatever reason things fall through, if for whatever reason you never raise money through a stock round, the SAFEs wouldn't convert and you wouldn't have to repay the money back. So both of these options are very good options for early stage fundraising, and there's a lot of subtlety to how you address these. So if you have any specific questions about these, feel free to throw them in the chat. We can come back to them. We can also, I'm also happy to chat about any sort of specific questions you might have about these SAFEs or these convertible notes one-on-one if you're considering either of these options. And then, as I've mentioned, it's very common to actually just sell stock at some point in your company's life cycle. As a founder, if you have a corporation, you're probably familiar with the term of common stock. That's just the general stock that people might own in your company. What's very common once you start raising money or large amounts of money from investors is to sell preferred stock. What this just means is that just like with common stock, it would represent certain ownership percentages of the company, but preferred stockholders are going to have certain preferred rights over the common stock. This comes up in a few different ways, a couple of which are in terms of what would happen if you sell and liquidate the company. Those preferred stockholders are going to have certain protections as to ensure that they get at least a certain amount of money back before the common stockholders get paid out. And similarly, you might have to give up certain consent rights around activities that the company might do, meaning you'd have to go get the consent of the preferred stockholders before you do certain major company activities, such as selling a new class of stock, such as selling the company or liquidating the company for other reasons. So preferred stock really just means that they have certain preferred rights over the common stock. And the idea here is that you're going to sell preferred stock when you're raising a bunch of money, and in exchange, those investors are going to expect some additional protections on their investment. Raising money on a preferred stock round is a really complicated process. It's a big ordeal, not one that you want to take lightly. So you really don't want to do preferred stock unless you are raising a bunch of money and it's necessary for that investor to come in and raise that money and provide you with that money. And then finally, you can always do debt. As I mentioned, notes are a form of debt, but there are also things like conventional loans or lines of credit that wouldn't convert into equity. They're just a straight debt or a loan arrangement. So you'd have to repay that with interest over a certain period of time. All right. So as I mentioned, we do work both on companies, both for companies as well as for investors. And so we get to see a lot of what the investors are looking for from both sides, right? And so that helps you be able to understand what you need to be doing, how you need to be pitching, and how you need to be approaching your company as you're looking for funding. So investors are really looking for a strong team. So that's you, your other founders, your advisors, your employees, your consultants. They want to make sure that your team has the experience, the time, and the skill sets to address the product or the service that you're trying to implement. So, for example, a venture financing group who's going to be writing you $1 million check is going to want to know that you, as the founder, who are, have the expertise in the product, have been developing the product and rolling it out, are going to be there full time. That you have the connections, the capacity, and the motivation and the passion to be able to turn this into something real, right? Because again, they're going to be looking for a return on their investment. And if they have concerns about your commitment, your skill set, your capacity, they are going to be worried about putting their money in because they will be worried they won't necessarily get it back. They're going to be looking for coachable executives being people like you as the founders, the CEO, the COO, the CTO, whatever executives they have. Investors are going to want to come in and be able to provide feedback, insight, expertise. So they want to know that they're not just giving you money and then you're going to do whatever the heck you want with it. And they want to be able to come in and work with you, right, as advisors, as collaborators, and they want to help be able to coach you to take that company to the next level. Think about these investors coming in, particularly groups like venture groups, and especially if they promote themselves as providing mentoring or advising services. Think about them as really strategic partners here. So they are coming together because they want to collaborate and help take this company to the next level. And if they're concerned that you will be resistant to their coaching, that you won't see that relationship as a partnership, as a team, they're going to be nervous about putting money into your company. Of course, they're looking for a good idea, right? And that's kind of up to you and your pitch to be able to communicate. Also, don't be dissuaded if not everyone thinks your idea is a good idea, right? It's not necessarily that every idea is seen as good by everyone. What's really important here is finding the right investors who believe in your idea. And that requires you to be able to pitch your idea correctly to them. And lastly, they're looking for something they can add value to. And this really depends on the investors. But this is also something that you want to be thinking about. Just like they're looking for coachable executives, you want to look for a good mentor with these investors. You want to look for someone that you can turn to for strategic connections, for advice and skill sets that you might not have or that you can build upon. And so they want to know that they can provide value. And similarly, you want to know that you can look to them to provide value. As I mentioned here, yeah. So what should you be looking for with an investor? Filling holes in expertise. So if you are trying to position into a certain market, or you're trying to expand your product into a specific offering line or pursue a specific channel for marketing, your investors might help you fill a hole in expertise and give you that insight and understanding how to frame your company and position your company for success in that specific space. These investors will also have strong backgrounds in establishing and running successful companies. And so you should look to them to be able to help you provide that advice. I always recommend to companies that if a specific investor is approaching you, or if you're approaching as an investor and having serious conversations about moving forward with the financing, particularly one where they might be getting a board seat or having other sort of rights in the company that dictate how you run the company day to day, make sure you understand what that investor's track record is. Talk to other companies that they've invested in. If you're joining an accelerator program that's taking equity in exchange for providing mentorship services, Talk to other companies that have gone through that program, and try to understand, will this benefit me? Will this get my company to point C in our path, right? And so you need to understand what the value is here that they're providing beyond just that money, and whether or not what they're providing in addition to that money will help you get to your goals. Finally, generally just want to make sure there's a right culture fit. Obviously, culture is this word that's thrown out left and right. Everyone talks about it. But if you feel a positive relationship with an investor, that is incredibly important in ways that people often underappreciate. Because if you run, again, if it's a mentor if it's an investor who's coming in to provide certain mentorship services for you, provide expertise on different issues, you need to make sure that they fit with you, with your team, and with how you structure the company. Very important to be thinking about. All right, what can you do to actually increase your chances of getting funding? This first one is probably the most important. Make sure you have a clear understanding of what it means to have a successful fundraise and what it means to have a successful company. If you are pitching to investors and you can't explain that to them, they're going to be turned off. They're not going to know, why am I giving this money? Where is this money going? What are you pushing for? How am I going to get a return on my investment from you? And so you want to have a clear understanding of, this is what we are trying to do with our company. This is where we want to go. This is how the money that you're contributing, this is how the expertise that you're contributing is going to help us get there. Make sure you do your homework. Again, understand that investment group, understand what types of investments they make, what they're looking for, understand their team. If you can ask their team specific questions about their experiences with investing, with experience with their portfolio, with their experience in their professional lives, in order to establish that connection and understand the value and the relationship that your company will have with them, that will make great strides towards having a positive investment round. Make sure that you have your books and your records in order. As I mentioned, particularly if you're doing a preferred stock financing round, it's complicated. It's a big process. And part of that process involves those potential investors coming in and doing a comprehensive due diligence review of your company. They're going to be coming in and they're going to want all the different details you have about your company, from current contracts to ownership and equity agreements, to intellectual property agreements, to a current org chart, to all your tax filings. They're going to want to see all of those materials. And if you don't have that available, it's going to be a red flag for them. So it's very important, as you start thinking about fundraising, that you're talking to your attorneys, to your CPAs, to your other advisors, to make sure you have all the appropriate materials ready to go. Because if then you can hand that money off to a potential investor, or even down the road, just hand those files off as part of diligence to a potential acquirer or purchaser of your company, that will speak volumes about how your company operates. Make sure you're realistic. So again, if your company only needs $500,000 to hit the next milestone that you need, don't go in saying, we're in the next year going to be achieving 1 billion customers all around the world, and we'll do that with $1 million, or we need $20 million in order to become the next Facebook, and we know how to do that in the next 5 years. You need to be very realistic about your expectations and appropriately structuring those expectations so investors have a clear idea, again, of where their investment is going. Also, make sure that you prepare a term sheet. And this really depends on where you're located, what types of investors you're talking to, because sometimes the investors will have a term sheet they'll provide you. But have a conversation with your attorney before you go out and pitch to make sure that you know what you want from a fundraising round. How much money are you planning to raise? What type of valuation do you think is reasonable for your company? How much are you willing to give up in terms of actual equity ownership percentages? What types of rights are you willing to give a potential board member or the new stockholders? Are you willing to give up any rights that you have or limit your ability to do certain things with the company? These are all different things that would go into a standard term sheet. And so even if you don't prepare a comprehensive term sheet, knowing some of the key terms there will be very important so that you can step into those conversations with investors with confidence. All right, when you're getting ready to go into that actual investor pitch, these are some important things to know. So you've already gotten into, in the door, maybe you've already had a conversation with someone from the team, someone they know. Make sure that you know your basics, right? You know your team, you know the product, the problem you're trying to solve, your market, you know how you're solving that problem. Because if you can communicate that stuff clearly, it lays the appropriate foundation to then have more serious conversations with that team. You want to, again, do your homework, know your investor, know their interests, know what types of companies they invest in, what markets they invest in, what types of founders they want to work with. Make sure you practice your pitch and have confidence in your idea, your company, and the success in your plan. Make sure you have a specific ask, right? So again, know how much money you want to ask for, what you're willing to give up. And even if in just a very simple slide, you can have a very clear ask. You're not, kind of wishy-washy about what you want or waiting for them to propose something. That directness, that forwardness, that assertiveness is going to be very, very important for those investors to respond quickly. And then lastly, keep it short and simple, right? Get to the point, get to the important things. This is part of knowing your investors. Again, knowing what their motivations are. Are they just looking for ROI? Are they going to want to have a significant impact in a particular market? That will help you keep it short and simple and direct to what they're going to want and expect and what value they're trying to look for from an investment. Unfortunately, sometimes if you're going out and having conversations, you'll just keep getting faced with no, 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 right? So investor groups will just not respond. They'll tell you they're not interested. They don't want to hear it in your pitch. You're going and you're having pitches and they're just telling you they're not interested in this at this time. This might happen for a couple reasons. One, investors might just see too much risk in that opportunity. And that could be because you're just not approaching the right investors for where you are, right? So if you just have an idea, you haven't started generating revenue yet, it might not be appropriate to go have conversations with venture financing groups yet. And so if you keep reaching out to those groups, you're getting disheartened because they're not reaching back to you. Might just not be the right investor group you're reaching out to, and they might see too much risk. So you want to tailor your pitches and your outreach to a different type of investor that's willing to take on the risk. You could also think about giving up other protections, giving those investors certain rights in order to decrease that risk of the opportunity for them. Again, make sure you talk to your attorney before you go out and you're having these conversations so that they can really help you understand the full scope of the risk that you're presenting with your investment and how you might be able to tweak that. If you're early stage, it might make sense to apply to an accelerator to get you to the point that you need to, again, have a company that's appropriate to pitch out to various investors. And finally, you can take the approach of building, a quote unquote real business. Again, a business that doesn't need large rounds of money in order to get where it needs to go. Set your expectations differently, adjust how you want to approach the company so that you can become revenue positive and actually grow off of your profits. So a lot of modern startups are just seeking investment after investment after investment, and they don't actually become profitable for a long time. And that just might not be the appropriate pathway for your company. So Fourscore has got a comprehensive set of startup resources on our website. Highly, highly, highly recommend checking these out. They're all free. You can go to our website. It's just fourscorelaw.com. Again, I'll have that at the end of the slides here, and access all these different resources. We have a very comprehensive blog that goes through all different issues that our clients are facing. We're constantly updating that. We have a new business blueprint, which is a full long white paper that explains essentially in a checklist format all the different things you would need to do to get your company off the ground. We have a video series oriented around different issues that you might face. So if you don't want to read blog articles, you can check out that video series. And then we have some PDF downloads on specific issues as well. If you're a company that's focused on blockchain or cryptocurrency, there's some specific insights there into those markets. If you're doing things about the Internet of Things, which you might be if you're a part of Riot, we've got a white paper there that explains some issues there. And then also just some, more tangential issues such as fitness and founders, maintaining your physical and your mental well-being as a founder and starting a new company. Again, all these resources are available for free on our website. Highly recommend checking them out if you have any questions about different issues here. With that, my contact information is below here at the bottom of this slide. It's just Sean, S-E-A-N, at fourscorelaw.com. You're welcome to reach out to me at any time if you have any questions. As I explained, we have, we provide different types of legal services, but you can also turn to me or other members of our team if you have just general questions about how to properly set up or structure your business, whether that's just the actual legal needs or different business needs in order to position yourselves for success. And we're available to address those questions at any time. So with that, if anyone has any questions, I'm happy to answer them. Otherwise, I will turn it over to Natalie for us to wrap up here.
Awesome. That's so great, Sean. Thank you. Those are some awesome resources you guys have available.
Absolutely.
We'll leave the chat box open for just another minute or two. As a reminder, Riot hosts Lunch and Learns weekly on Wednesdays at 1 p.m. Eastern Time. You can find a list of our Lunch and Learns on Meetup where you registered for this event. This event was recorded and will be posted to Riot's YouTube channel and the Meetup page where you registered for this event. Thank you all for joining today. I'm not seeing any question. Oh, here's a question. Which is preferred, pursue IP or create the business?
So I'll kind of touch on a couple of different considerations here. So totally depending on the type of intellectual property we're talking about, because if you're developing a company that's oriented around intellectual property that requires a patent or some sort of other actual protection like that, it's going to be very important to make sure you have a strong understanding of that. When we talk about creating a business, I think it's important to just make sure that people understand what a business actually is. And sometimes I do a whole other presentation on this, like what types of businesses to set up and what that means. But a business at its core is just a way for you to shield your business activities from your personal assets, right? So what you're doing, and we call this a corporate veil a lot of times in law. But what you're doing by setting up a company is creating this corporate veil between your business's activities and your own personal activities. So if anything happens with the business and the business gets sued, this corporate veil is protecting, you're shielding your personal assets from liability there. So the worst thing that could happen if there was some big lawsuit involving your company and they came after you, came after the company, is that the company might go bankrupt or owe a lot of money, right? But your personal assets would be protected as a stockholder. Of course, there's other nuances to that, like if you're a director of the company and you owe the company certain responsibilities as an individual, you owe the stockholder certain responsibilities as an individual. But in general, the idea of setting up a company is that you're protecting your personal assets from company activities there. So we really say that what's particularly important and when you need to be creating the business is before you're doing any sort of contracts, entering into any sort of agreements, or taking any sort of money or having relationships with third parties, right? Because as soon as you start doing that, your company is exposed to different liability. And if you don't have a company set up, you're just doing that stuff in your own name, you are exposing yourself to risk there. So there are a couple different things to balance here. If you need to have a strong IP portfolio, and you just don't know if you're going to get there, it might not make sense to have the company yet, because you might just never need it. But if you're going to be developing IP by working with contractors or university, or you're going to be entering into development agreements to build out some software, all of that stuff should be done in the company's name, and all the funds for that should flow through a company bank account. And so you'll want to have the company set up before you do anything like that.
Awesome. That's great, Sean. Those are all the questions I see for now. So thank you, everyone, and hope everyone has a great rest of their day.
Thank you, Natalie. Have a good one.
You too. Bye.